I want to welcome you again to the Contributed Capital's continuation saga. This is, I think, part 4 of this video for this chapter. What we're doing on this one is stock options, and basically it's employee compensation by giving them stock and how the company records it. So this is information that you can find. Employees may need they have to meet certain criteria. The stock options give employees options to purchase during a specified period of time, specific number of shares, and a specific price. Problem is we have to come up with some kind of valuation for it. So here's an example. If it's measured at fair value at grant date, okay, then it measures the service over the vesting period. On January 1st, 2013, the company granted 100,000 shares of $1 par common stock within the next 8 years starting 12/31/16. So they grant it today, but you can't start it until after 12/31/16. The exercise price is a current market price of $35 per share. The value of the options is estimated to be $8 per option. If the employee leaves, the option is void. Okay, so on January 1st, 2013, a memo is entered. Then at the end of the year, we have to calculate how much do we need to put in for the expense, the compensation expense. So the fair value, we'll do it this way, is $8 per share. The option granted, how many option shares? This is the number of shares that's granted, and that was for 100,000. And then so your total would be you would take the $8 times the 100,000, or $800,000. That's over the period. But it's 4 years before they can start granting it, so that's the vesting period, because you have 2013, 14, 15, and 16. So it's 4 years, so we have to recognize $200,000 a year. So the entry for that would be compensation expense. And that is for the 200,000, and additional paid in capital for stock options, and that's 200,000. And okay. This is for 13, 14, 15, and 16. You'd have the same entry, 200,000, as long as nothing changes. Okay. Now, half of them are exercised. So that'd be cash. And that would be for, see how many, 50,000. Whoops. Be an equal sign. Times $45. Oh, $35. I went up $10. Okay. And then we want to debit this account. Not all of it, because we're only exercising half of it. So that would be for 400,000. Because remember, it's 800,000 altogether, so you want half of that. Okay, so that's Apex stock options. We'd credit common stock, and that's for, it would be 50,000 if you want, times the what's it, $1? Yeah, $1 par value. And then additional paid in capital common stock would be for this one plus this minus this. And those are both credits, so we have to make them credits. Okay. If you let the balance expire, we would have additional paid in capital is a debit for stock options for the 400,000, and then we have additional paid in capital expired stock options. For the 400,000. And that's a credit, so we want to make it look like a credit. Okay. Now that's if the balance expire. Of course, if they exercise it, then you have this entry up here. Okay, if we did this and then we say, okay, we expect 5% of the forfeitures the first 2 years, and then in 2015 it's going to raise to 10%. Okay. So the entry, same example, except instead of 100%, they're going to expire. They're going to expect 5% of them not to ever to expire. So we do a compensation expense. We'd actually take the 200,000 times 95%, which is 190,000. Because you take the 200,000, you expect 5%, so you take it times 95%. And then the APIC stock options would be also the 190,000. Okay. And in 2014, we have the same entry because nothing happened. So I'm just going to copy it down to make life easier. And that's 190. Yeah, too many zeros in there. Okay, because it's the same entry for 2014. Now, in 2015, that's where we think, okay, it's going to raise to 10% after. So we see what's in the account. We have 380,000 in the account right now because we have 190 plus 190 is 380. If we take the 800,000 times 90%, which is what's left, divided by 4, it'd been 180,000 a year times 3 years, which means we'd have had 540,000. The 540 minus the 380 gives us the 160. So for this year, to get the 540, we need this account, but the difference is we only need 160,000 in the account because that's what we expect to actually happen. And that gives us up to a balance of 540,000 because you have the 180 plus the 180 plus the 160 now gives us the 540, which is what we would expect. And then the last year, the debits and credits are the same. The only difference would be we'll do the 180 because that's what it would have been if we had done it all along. Because we kind of calculated that already based on right there. That's the 180. Okay, that's the amount we want right here is the 180,000 because that's what it would have been each year if we had done it consistently. Okay, that takes care of that one. Now, this is for vesting. What we have is a 3-year process. 20% is vested the first year, 30% is the second year, and 50% the third year. Okay, so this is for total shares. Is 100,000 shares is what we're going to have as an option. But after the first year, it's only 20% of it's actually vested that's available. Then 30, and so here's the future value options: the $3.50, $4, and $6. Those will be given. Okay, so that means over here we would take the 100,000 times our percentage to get the number of shares that we're talking about. So it's 20,000. And then for the second year, it's times 30% and times 50%. So it's 20,000, 30,000, 50,000. There's the option. So to get the value, we would take the 20,000 times the 350 to get the 70,000. And then we do the same thing for the next one, except it's 30,000 times 4 and 50,000 times the 6. And that gives us a total of 490,000. Okay. Now, to record this, in 2013, our expense would be $70,000, and our total would be $70,000. On this one, it's $120,000 divided by 3. No, divided by 2, sorry. It's only for 2 years. Divided by 2. So that's $60,000 each year. So that would be a total of $120,000. Okay. Let's make this a little bit easier. There's what I'm looking for. Okay. In 2003, that's a 3-year plan. So what we have on that one, we would take the first one, we'd have equal the $120,000 divided by 3, which is the whoops, I took the wrong number, didn't I? Let's try that again. The $300,000 divided by 3 is $100,000. Okay. So it takes 2 years to get fully vested. So that's $100,000 each way, which gives us a total of $300,000. Okay. And then we add these columns up. Oh, let's try that again. I don't want that first one in there. Okay, $230,000. Let's add them across. $160,000 and $100,000, and that one didn't add up right. Oh, I think we had this one in right. $300,000, $490,000. Okay. Then also have and that's how much you invest each year. Okay, we also use a straight line. $490,000 divided by 3 is $163.33, as long as this one exceeds any one in the given year. Well, that one's only $70,000 that first year, so okay, then so it's okay. Okay. The amount recorded must exceed amount vested. So in 2013, I'll put a little hyphen there. $230,000 will be recorded. Only $70,000 is actually vested, because this is the amount in 2013. This is the amount is actually vested in 2013, and we invest $230,000. The next year we have another $160,000 vested, so a total of $490,000, but we'd actually only need $190,000. Okay, and that's why I say you can use $163,000 each year, as long as the amount actually vested is less than that, because this is 70, 163. The second year you'd have 326, and we need 190, so we could do it that way also. Okay. Option-based performance. This is a little different. We'll save that for next one.